Welcome back to FluxFolio Finance, your gateway to understanding the tectonic shifts in global finance. Today, we're staring straight into the fog of a so-called breakthrough. It's May 12, 2025. The US and China have just announced what appears to be a truce in their escalating trade war. Markets are rallying, headlines are euphoric, but beneath the applause lies something more dangerous. Because in this game of global chess, a handshake doesn't mean harmony. It could just as easily mean a temporary freeze before the next cold snap. So what really happened in Geneva? Behind closed doors, U.S. Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer emerged to declare substantial progress. No figures. No full documents. Just the promise of a joint statement scheduled for tomorrow. On China's side, Vice Premier He Lifeng echoed the optimism, citing important consensus. But what does that really mean? According to early reports, a 90-day tariff pause has been agreed upon. The US is temporarily dialing back its brutal 145% tariffs on Chinese goods. China, in turn, is softening its 125% retaliatory wall. Think of it as both sides loosening the tourniquet just enough to keep the limb alive, but not enough to heal it. For markets, this was good enough. US futures spiked, S&P 500 E-minis up 1.3%, Nasdaq futures up 1.6%. The Chinese offshore yuan nudged upward. And for now, the world exhaled. But is this a true breakthrough or just anesthesia before the surgery? Let's unpack the economic meat of this deal. First, technology and semiconductors. This is the real battlefield. The US has choked China's access to cutting-edge chips, especially Nvidia's AI hardware, while China retaliated by tightening exports of critical minerals like gallium and germanium. This new deal may ease restrictions for non-military chips and certain supply chains. But make no mistake, the strategic tech wall is still very much intact. Next up, pharmaceuticals. One of the rare sectors where both countries had already carved out exemptions. The US depends on China's APIs, active pharmaceutical ingredients. China depends on American biotech. A formal easing of tariffs here could stabilize drug prices and global supply chains. But again, only if followed through with real enforcement. Then there's aerospace. Boeing, once the poster child of US exports, has been sidelined by tariff disputes and safety issues. If this deal gets planes back in Chinese skies and spare parts flowing again, it could mark a turning point. Airbus, however, might not be cheering. Agriculture was also on the table. China's food security remains fragile, and US farmers, especially in soy, pork, and corn, are desperate to reclaim market share lost to Brazil and Argentina. The 125% retaliatory tariffs had crushed US exports. If lifted or eased, it could pump billions back into America's rural economy. But will China trust US reliability in an election year? And then, the consumer goods sector. This is where the pain has been loudest. Everything from sneakers to smartphones saw prices rise as tariffs squeezed both sides of the Pacific. The 90-day pause may allow an influx of cheaper goods. Great for inflation data. Maybe not so great for American manufacturers fearing a flood of imports. But here's the broader frame: the pie they're splitting is shrinking. Bilateral trade between the US and China is projected to fall from $760 billion in 2022 to just $650 billion this year. The US is running a projected $450 billion trade deficit with China. Meanwhile, Nomura warns that up to 16 million Chinese jobs are at risk due to collapsing exports, and Goldman Sachs expects US inflation to remain at 4% by year-end, even with this deal. So what does all this mean for the world economy? The IMF and World Bank have already cut global growth forecasts. The IMF's Kristalina Georgieva said tariffs above 50% risk a crippling fragmentation of trade. The EU has launched €50 billion in tariff shields. Canada and Mexico are redrawing their supply maps. This is no longer just a bilateral conflict, it's reshaping global commerce. And yet, the elephant in the room hasn't budged: US Treasuries. The Fed's balance sheet has not expanded. The US is facing a refinancing wall, with $3 trillion in debt maturing this year. Yields are soaring. And countries like China and Japan have been quietly dumping treasuries, shifting toward gold or strategic assets. This trade deal might buy time, but it doesn't restructure America's debt. It doesn't rebuild trust in the dollar. And it doesn't solve the confidence crisis gnawing at the heart of the world's most important bond market. Which brings us to the critical question, is this deal the beginning of the end, or just the eye of the storm? Because here's the danger, if this deal fails, or even just underwhelms, the markets will know. Volatility will return. Bond yields will spike. And a fragile world already reeling from energy disruptions, cyber attacks, and monetary tightening might not survive another round of economic war. So, is the US-China deal a truce? Yes. Is it a transformation? Not yet. And is the crisis over? Absolutely not. Stay tuned, because tomorrow's joint statement could either cement a new chapter in global trade, or expose just how fragile this moment really is. This is FluxFolio Finance. Like, comment, and subscribe if you want to keep unlocking the signal beneath the noise. Until next time, stay curious, stay critical, and stay ready.